Welcome to the Lone Ranger Radio Show. My name is Bruce Woodburn, and yes, I am the Lone Ranger. Welcome to my show. This is a show where we talk about how to buy real estate, how to sell real estate, how to save money when you're getting a mortgage. What's the best type of mortgage for you and your family? Not every mortgage is the same for everyone. Some are maybe should be looking at FHA, some VA, some conventional, some maybe jumbo, some maybe USDA, zero money down. The Lone Ranger has them all. That's right. I got to tell you something. I think that my company offers more loan programs than any other mortgage company I've ever seen in the history of my 33 years in the business. Yes, that's right. 33 years in the business. At least it'll be 33 years on March the 18th. That is the anniversary that I will have been in this business for some time. Same location for like 26 years. Right here in Winter Park at I-4 in Fairbanks on the Fairbanks Curve. Everybody knows that Fairbanks Curve, don't they? Well, let's talk a little bit about how to save money when you're buying a home and what is the best mortgage for you. So let's just start off with VA loans. If you're a veteran out there, there's a lot of companies out there that promote themselves as being the lender for veterans. But I'm going to tell you something. There is not a mortgage company around that you will find that has more experience with VA loans and caters more to a veteran than we do at CrossCountry Mortgage. We are a direct VA lender. See, what you may or may not know is VA does not loan money. They insure the VA loan. So they are like the PMI company for a VA loan. They don't actually loan money at all. They set the rules and the guidelines of what you need to do to qualify for a VA loan. And then us as lenders originate the loan, fund the loan, and then VA insures it. So we are experts on VA refinancing. You know, you can go up to 100% on a VA refinance. Your best options on a refinance for VA is going up to 90%. Now, if you're refinancing a VA loan to another VA loan and you don't need any cash out, you're just trying to lower your interest rate, you can do what's called an IRRL. That is an IRRRL for an interest rate reduction refinance. That's what that is. And we can handle that for you. We have experts in the field when it comes to that, and it saves you a lot of money. There's no appraisal necessary. But buying a home as a veteran, I have VA loans, 100% financing. Now, VA only allows for primary residence loans, but that doesn't mean you couldn't have bought a home using your VA, lived in it for at least 12 months, and then turned that into a rental property. I help a lot of veterans accumulate wealth by doing that. If you have any questions about VA, if you're active military or retired military, a veteran, just give me a call. I'm the Lone Ranger. You can reach me at 407-706-3313. That's 407-706-3313, or go to my website at webringyouhome.com. You will get the service that you never got from VA. Okay? I don't believe that VA and our federal government has done right for you, the veteran. But I'm going to tell you something. I'll make up the difference for you. My team and I will be here to cater to you day and night, night and day, and we will do whatever we can to assist anybody that has committed themselves to our military in any capacity. So VA loans, we are experts. Let's talk about an FHA. Well, actually, before we talk about FHA, let's talk about the only other zero down payment loan that is available, and that is USDA. And yes, USDA is the United States Department of Agriculture, and they do not do loans either, but they insure loans just like VA does. So they set the guidelines to ensure 100% financing. Now, there's some strict rules that apply to this, and it's not for people that don't have pretty decent credit, but you don't need any down payment. Here's the pros of a USDA loan. Great interest rates, very low mortgage insurance premiums, very low, one of the lowest in the industry. However, they only will insure loans in certain geographical areas. What they look at as low density or rural areas. Now, you don't have to buy a farm to get USDA. I have done lots of loans in Lake and Osceola, Polk County, some in Volusia County, even some remote areas within Orange County, but almost nothing left in Orange County or Seminole County these days. But I will guide you in the right direction. I'll set you up so you have a direct link to the USDA website. The first step is to get pre-approved for USDA financing. They are pretty strict on credit scores. You got to have at least about a 645 bare minimum, and you cannot own any other real estate whatsoever, and you're not buying a home that's got a pool on it. The rest of it, if you qualify and your ratios are under 43%, total debt ratios, including the new mortgage payment, maybe USDA is the right option for you. Let me know. I have a team of experts on standby. Call me at 407-706-3313, 407-706-3313, or WeBringYouHome.com. What a perfect first-time homebuyer program. It's a little bit more restrictive for many of you, but if you meet the guidelines for it and you can find a home that's in an area that's qualified, it's probably the best first-time home buyer program aside for VA. But of course you have to be a veteran to get VA or active military. So USDA would be the second best for zero down payment loans available. Now, let's talk about the most popular first-time home buyer or a loan. You don't even have to be a first-time home buyer. You can own other properties. You just can't have another FHA loan. FHA, only 3.5% down. Here's the great news about FHA. Credit scores are flexible. Most lenders won't do a loan on FHA under 640. Some will go to 620. Some may go as low as 600. Not very many, though. But the loan arranger at CrossCountry Mortgage, Bruce Woodburn and his team, we don't even have credit score requirements. We don't look at what your credit score is. We look at the overall picture and whether that loan can be insured by FHA. FHA, again, does not do mortgages. They insure mortgages for you. That is called MIP, or mortgage insurance premium. So you can see all these different types of mortgages have different names for what they call the mortgage insurance on it. And FHA is a mortgage insurance premium, or MIP. USDA is a guarantee fee, and VA is called a funding fee. So now FHA, super flexible on credit, income, assets, a little bit more restrictive on things like student loans and things like that. But I'm going to tell you something. I do more FHA loans for first-time home buyers and people that don't have excellent credit than any other loan. It's a beautiful loan, great interest rate, low down payment, beautiful home to get started in. And right now, if you look at what your requirements are for FHA, FHA really did us right when it came to adjusting loan amounts. And right now, your loan amounts on FHA are pretty darn substantial. So you can get into an FHA loan at about $380,000 and still get in for very little money out of pocket. Very little money out of pocket. If you have a score less than 580, you will be required to put down 10%. But if you have a score at 581, I may be able to get you into the home with only 3.5% down. Doesn't get any better than that. Now, my team of experts here at CrossCountry Mortgage on the Loan Arranger team are also skilled in making sure they refer you to the right real estate agent. Why do I want you with the right real estate agent? Because if you're a first-time home buyer, you probably need a little help when it comes to your cash to close in terms of closing costs. So I want a realtor that's going to negotiate closing costs for you. Don't get fooled by a real estate agent that says that sellers aren't paying closing costs in this market. Is it harder? Yes. Is it possible? Yes. You just call me. I'll make sure that you go in the right direction and we get you with the right folks. I don't make any money by referring your deal off to a real estate agent, so don't think that there's anything other than me having a motivation to help you become a homeowner. That's the only reason. But if I know who you're using as a real estate agent, then we can work as a team in concert to make sure that it's best for you. If you have questions about FHA loans, my team is here to answer all your questions. I do return phone calls on Monday. You can call me on my personal phone number, text me on my personal phone number, 407-706-3313. That's 407-706-3313. Or go directly to my website at webringyouhome.com. All of these programs offer you the ability to have 100% gift funds when it comes to your down payment and closing costs. So there are limitations, but there are very little limitations, and we know all the rules and how to navigate so that we make sure that you are getting the very best that's available. So now, from FHA, we're going to go to conventional loans. Conventional loans are the most popular loan, but there are more restrictions. Now, when I ask a real estate agent which is the best loan for a client to get when it comes to making sure that they're the most qualified, they always tell me conventional loan. The problem is they're not correct. Yes, you are not correct, Mr. and Mrs. Real Estate Agent, because a conventional loan is not the most safe loan for a client to get into. The safest loan for a seller to choose when evaluating multiple offers is the loan that the client is most qualified for. Not the type of loan, but how well is that client qualified. I can show you a VA loan with a zero down payment borrower that's better qualified than one putting 25% down on a conventional loan. Excuse me. It just depends on how well that buyer is qualified. Now let's talk a little bit about conventional loans. What is the minimum down payment for a property that you want to buy as an owner-occupied property? What's your minimum down payment? Well, I can tell you what it is. It's 3%. So 3% down. So $300,000 house, $9,000 is all you need to get into that transaction. Now, if you go with a 3% down, the seller is limited to how much they can pay in closing costs, but it's pretty generous. They can pay up to 3%, so that would be $9,000 toward your closing costs. That should get your closing costs covered in their entirety, at least for the most part, depending on the property that you're buying. Your next down payment requirement, if you are not a first-time home buyer, is 5% down. 5% is very, very popular, and anytime you're putting less than 20% down, you are subject to private mortgage insurance. So private mortgage insurance, some people go, oh, I don't want private mortgage insurance. Let me tell you something, folks. Private mortgage insurance is amazing. It's great. Now, when I'm teaching classes to real estate agents, they'll look at me like I've lost my mind. What do you mean private mortgage insurance is great? We don't want private mortgage insurance. Let me tell you, folks, if it wasn't for PMI, MIP, funding fees, or guarantee fees, all of you would be forced to put down 20%, and only about 15% of the American population would be a homeowner. The rest of you would be renting from people like me. So PMI is amazing. We'll get rid of it later. It's okay. You're leveraging money. You're putting less money down. Quite frankly, every house I ever bought, I paid PMI on it, and I made more money than those who can save 20% to put down. All right, next step, 10%. As the more you put down, the lower your PMI factor gets when it comes to conventional loan. And how are credit scores evaluated on a conventional loan? Well, Fannie Mae and Freddie Mac are what are called the agencies that insure the loans and create the guidelines for all of us in the lending industry for conventional loans. So Fannie Mae and Freddie Mac do what's called risk-based pricing. What does that mean? It means the higher the risk, the higher your rate. So when you're shopping around for a mortgage and you have a 620 credit score, are you going to get the same interest rate as the buyer that's got an 810 credit score? No, you're not. You're not. It's not going to happen. So when it comes to conventional loans, the higher your score, the better your rate. The higher the mortgage, the better the rate. The more the down payment can sometimes be a benefit. But I've seen clients that have put 5% down and I was able to get them a better interest rate than putting 20% down. Why? Because Fannie Mae and Freddie Mac believe that if there's mortgage insurance on a mortgage, you're a lower risk. I think that you're a lower risk by having more skin in the game, but Fannie and Freddie don't believe so. So their pricing engines price you higher with more money down. But listen, it's inconsequential. I don't ever want you to get caught up on a mortgage because you're putting more money down and the rate might be slightly higher. I'll be back in 5 more minutes with more of the Lone Ranger Radio Show with Bruce Woodburn, CrossCountry Mortgage. Stay tuned. I got a great market update. Don't go anywhere. WeBringYouHome.com.